Welcome back to the deep dive. Today, we're tackling Opendoor Technologies, that's ticker OPEN, and their Q3 2025 earnings report. And this one's a real head scratcher for anyone watching the markets. It presents this, well, almost paradoxical situation.
It really does. It's the classic finance contradiction.
Yeah.
You got Opendoor delivering this massive beat on revenue, way more than Wall Street expected. But, and this is the big but, they simultaneously posted a profitability miss that was so severe, it just completely overshadowed everything else, dominated the market reaction.
Right, exactly. That's the puzzle we're here to solve today. How does a company manage to sell, what was it, 7% more than expected?
Yeah.
And yet somehow lose 71% more per share than the analysts were forecasting? It just doesn't immediately add up.
Yeah, it's jarring.
So our mission today, for you listening, isn't just to, read off the numbers. We want to get past those headlines. We're going to use a structured 5-part framework. Think of it as 5 key slides to really dig into the underlying unit economics. We'll look at the new management's pretty dramatic strategic shift, and ultimately we want to pinpoint that smoking gun, the real reason the stock took such a hit.
We need to understand the background here. The main question for you, the listener, is this. A company beats on revenue estimates. So why on earth did the market react by sending the stock down, 6.71% in after-hours trading? The fact that it did tells you basically everything you need to know. Investors, they weren't looking at sales volume. They were zeroed in, laser-focused on the collapsing margins and, frankly, the really weak guidance they gave for the future.
Okay, let's not waste any time then. We're diving straight into our structured material. We'll kick things off with the foundational results. All right, slide 1. Let's unpack that initial shockwave, the contradiction we mentioned. The headline numbers, they actually start pretty strong, right? A definite win, you could say, for the sales team. Total revenue for Q3 2025 came in at $915 million.
Yep, $915 million. And that blew past the consensus estimate. Wall Street was looking for around $851.7 million. So that's a 7.4% beat on the top line. That's not insignificant. It suggests, they're pretty good at moving houses. Get them sold.
They moved the inventory, sure, but like you said, at what cost? That big revenue number was just completely overshadowed by the miss on profitability. Wall Street, they were bracing for a tough quarter. They modeled a diluted earnings per share, or EPS, loss about 7 cents, right?
That was the expectation.
Yeah, a loss of 7 cents per share. But the actual reported loss, it came in at $2.12 per share, 12 cents loss. Whoa. Okay, hang on. Let's pause there. A loss of 12 cents compared to an expected loss of 7 cents. That's a 5-cent wider loss than anyone was anticipating. That's doing the math quickly. That's a negative surprise of over 71%. That's not just like a minor miss. That's a really severe breakdown in the underlying economics of each sale.
It absolutely is. It's a flashing red light. Seriously. For you listening, when you see this specific pattern, a revenue beat, combined with an EPS miss, especially one this bad, it is the single clearest, most classic signal you can get of severe margin compression. It screams trouble. It basically means the company is succeeding at generating sales, yeah, but the profit they're making from those sales, it's just not enough, not nearly enough to cover their overhead, their fixed costs. They're essentially busy selling their way into an even deeper financial hole.
And the market doesn't mess around, does it? It reacted instantly, ruthlessly, you might say. Those shares dropped 6.71% almost immediately after the report hit the wires. Boom.
That reaction confirms it. The market's focus was crystal clear. Profitability gap, poor forward outlook, that revenue beat. Almost irrelevant in comparison. A distant second thought.
Okay, so that's versus expectations. What about Opendoor's own performance compared to last year, looking at their internal JAP numbers year over year?
Yeah, if you look beyond just the comparison to estimates and look at the year-over-year gap performance, the picture gets even more painful. This is clearly a business that's contracting significantly. Total revenue, it fell 33.6% compared to Q3 of 2024. It dropped from nearly $1.4 billion, $1,377 million, down to that $915 million we mentioned. A huge drop.
And that contraction, and it didn't just stop at revenue, did it? Looking further down the income statement, where you really see the financial health. Gross profit fell even faster. It dropped 37.1% year over year, from $105 million down to just $66 million.
And that disproportionate drop is really crucial. Think about it. Revenue down by a third, roughly. But gross profit down almost 40%. That tells you, plain as day, they were selling homes at much, much lower margins this quarter compared to a year ago. Much less profitable per sale. And the consequence of that, the net loss widened by 15.4%. It went from a loss of $78 million last year to a net loss of $90 million this quarter. $90 million loss.
Okay, $90 million loss, and that's from $66 million in gross profit. Before we dig into how that $66 million just wasn't enough, let's quickly touch on something you mentioned, EPS, specifically basic versus diluted EPS. Can you explain that briefly? Why, especially for a tech company like Opendoor, maybe one that uses a lot of stock options, why is diluted the number we should focus on?
Yeah, absolutely. This is a really essential context, especially for these kinds of growth-focused, often Silicon Valley-style companies. So basic EPS is pretty simple. You take the net profit, or in this case, the net loss, and you just divide it by the simple number of shares that are currently outstanding, just floating around in the market. Think of the company's loss like a pizza, right? Basic EPS just counts the number of slices currently sitting on the tray to figure out how much loss each slice represents.
Okay, simple enough. But diluted EPS sounds like it adds a layer of, well, reality.
It's exactly. Diluted EPS aims to capture the full potential picture. It takes that net loss peeper, but then it adds in every potential slice that could eventually be claimed. This includes things like stock options granted to executives, restricted stock units, RSUs given to employees, maybe even convertible debt. These are all financial instruments. Think of them like coupons that could be redeemed for a share, for a slice of that lost pizza down the line. And since Opendoor, like many tech firms, relies heavily on stock-based compensation to attract and keep talent, the diluted EPS figure is always going to be the more conservative. And frankly, the more realistic measure of the actual loss per share that impacts every single investor, current and potential.
Got it. Okay, thanks for clearing that up. So with that distinction in mind, let's go back to the scorecard numbers because there's this this kind of weird divergence happening that we need to explain. Revenue fell 33.6%. Okay. The total net loss widened 15.4%. Got it. But the diluted EPS loss only widened 9.1%. Why the mismatch? Why didn't the per share loss grow as much as the total company loss?
Right. So you're seeing two distinct, powerful financial forces at work here, pulling in slightly different directions on the per share number. Let's tackle the first gap. Why did revenue shrink by 33.6%, but the net loss only widened by 15.4%? That is textbook negative operating leverage.
Okay, negative operating leverage. Can you maybe break that down for us slowly? What does that actually look like inside Opendoor's business model?
Sure. Think about Opendoor's costs. They basically fall into two big buckets. First, you have variable costs. These are costs directly tied to buying and selling a house. The purchase price, the renovation costs, maybe some direct selling fees. These costs generally scale up and down with revenue. Sell fewer homes, these costs go down. But then you have the second bucket, fixed costs. These are things like the salaries for their software engineers, the rent on their corporate offices, their big marketing infrastructure. And crucially, that very large debt servicing costs the interest expense. These costs, they tend to stay relatively flat or sticky, regardless of revenue volume in the short term.
Ah, okay. So when revenue just collapses, drops by a massive $462 million year over year, those fixed costs act like a heavy anchor, dragging down profitability even faster.
Exactly. The company is built, it's structured to handle a much higher volume of sales. So even when sales dropped, those operating expenses, they stayed pretty high at $134 million for the quarter. And that interest expense, it's non-negotiable. $36 million had to be paid, period. So the gross profit they actually earned from selling homes, that's $66 million. It was nowhere near enough to cover that combined $170 million plus in fixed operating and interest costs. This mismatch, this mechanism, is what forced the total net loss to widen disproportionately. It really highlights the structural rigidity baked into their model. They just can't cut those big fixed costs as quickly as revenue can disappear.
Okay, that explains the widening gap in the overall business loss. Now, what about the second divergence? Why did the net loss widen 15.4%, but the loss per individual share only widened 9.1%?
That difference comes down to the dilution factor. It acts like a mathematical cushion or a dampener on the per share number. What happened was the weighted average diluted share count, the total number of potential pizza slices, actually increased by 5.2% compared to last year. They issued about 36.6 million more potential shares into the market, primarily through that stock-based compensation we talked about.
So the total loss amount, the $90 million, was bigger. But because that bigger loss was being spread across more potential shares, the amount of pain felt by any single existing share didn't increase quite as dramatically as the overall business loss did. It's like spreading the same amount of damage over a wider area.
Precisely. It effectively smooths out the appearance of the diluted EPS number. It makes the per share pain look a bit less severe than the actual underlying cash drain the business experienced. And that's exactly why for these types of tech companies that issue a lot of stock, you absolutely have to track the share count alongside the profitability numbers. They go hand in hand.
Wow. Okay, so this rather painful picture of negative leverage, margin compression, and dilution. It leads us directly into the heart of the matter, right? The unit economics. All right, slide 2. Now, before we really dive into these specific profit metrics here, we absolutely have to talk about the difference between GAAP and non-GAAP accounting, because this is where management starts to, let's say, tell a slightly different story than the official audited numbers.
Yes, this distinction is so critical if you, the listener, want to accurately assess how the company is really doing financially. So GAAP, that stands for Generally Accepted Accounting Principles. This is the official rules-based language of finance. Think of it as the audited standardized truth. It includes every single expense, whether it's a cash expense like paying rent or a non-cash expense like stock compensation. That $90 million net loss we established back in slide 1. That is the undeniable GAAP reality.
Okay, that's the official picture. Then you have non-GAAP. This is what management often uses to present what they might call the core operational health or the underlying trend of the business.
Exactly. Non-GAAP, or you'll often hear it called adjusted metrics, is where management takes the GAAP numbers and starts excluding certain items. They argue these items aren't part of the normal, repeatable day-to-day operations. Things like maybe one-off restructuring charges, big inventory write-downs from past mistakes, and almost always that big non-cash expense, stock-based compensation. Non-GAAP is the picture management prefers analysts and investors to focus on.
And it's right here, when we look at the core unit economics, the actual engine of profit for Opendoor, that we find the clearest evidence of the Q3 failure. This is really the smoking gun behind that big stock drop we keep mentioning. The contribution margin. Can you define that for us? What does contribution margin actually measure?
Contribution margin is Opendoor's key metric for unit economics. It basically shows you the profit left over after all of the direct costs associated with buying, fixing, holding, and selling a specific home are accounted for. Think purchase price, renovation costs, direct selling expenses, holding costs like utilities and taxes for that specific house. What's left after all that is contribution profit, usually expressed as a percentage of the resale price.
Okay, so it's the profit per house before corporate overhead and interest. What happened to it in Q3?
It collapsed. The collapse here is frankly staggering. The contribution margin fell from a reasonably healthy 3.8% back in Q3 of 2024, down to a shocking 2.2% in Q3 of 2025. That's a 160 basis point contraction, 1.6 percentage points wiped out on the absolute lifeblood metric of their business. That is what sent shivers down the market's spine.
Let's try to make that 2.2% figure more concrete. Say Opendoor sells a pretty typical suburban house for, I don't know, $500,000. What does a 2.2% contribution margin actually mean in dollars?
Okay, good example. On a $500,000 sale, a 2.2% contribution margin means that after Opendoor pays the original seller, covers all the renovation costs, pays the direct selling fees, handles the holding costs, they're left with only $11,000. Just 11 grand. Now remember what that $11,000 per house has to cover. It has to cover everything we discussed back in slide 1, all the salaries for every single engineer building their tech platform, the entire R&D budget, the general and administrative overhead HR, finance, legal, and that massive non-negotiable $36 million quarterly interest expense on their debt.
Yeah, $11,000 per $500,000 home sounds, well, it sounds completely inadequate to cover all those massive fixed corporate costs, which is exactly why the total GAAP net loss widened to $90 million, right?
Absolutely inadequate. It's just not sustainable math. And interestingly, management themselves basically admitted the cause was tactical, almost intentional in the short term. In their commentary, they explicitly linked this margin decline to, and I quote, near-term pressure as we clear old inventory. They're essentially acknowledging they were forced to sell off poorly acquired homes from previous, perhaps less disciplined, quarters at heavily discounted low-margin prices, just to get them off the books, whatever the cost.
Okay, so the core unit economics got crushed, but this leads us to the really critical paradox of this slide 2. How on earth did the adjusted metrics actually improve when the contribution margin collapsed so badly? The GAAP numbers look terrible, right? Net loss widened, but adjusted EBITDA actually got better by $5 million. The loss shrank from 38 miches to 33 miches. And adjusted net loss also improved by $9 million, shrinking from a loss of $70 down to 61 meters. What's going on? How can both be true?
Right, it seems contradictory, but it comes down to that GAAP versus non-GAAP distinction we made earlier. The improvement in those adjusted figures is a hybrid. It's driven by two main factors. One factor is very real, operational cash savings. The other factor is more of a, let's call it a non-cash accounting adjustment. Let's look at the real part first, because it's important. Remember the new CEO, Kaz Najatian? He came in promising to be ruthless on expenses. And you know what? That promise is genuinely visible in the numbers.
Okay, ruthless cost cutting. Where specifically do we see the evidence of that?
You see it clearly in the total operating expenses line. This bucket includes things like G&A, general and administrative, sales and marketing, and technology development costs, basically the corporate overhead.
Yeah.
That total OPEX figure fell dramatically by $38 million year over year. It went from $172 million in Q3 2024 down to $134 million in Q3 2025. That is real cash savings. That's a significant operational achievement for the new management team. Cutting $38 million in quarterly overhead is huge. And that $38 million in real savings is a genuine driver behind why the adjusted loss looks better than the GAAP loss might suggest.
Okay, $38 million in real tangible savings. That's impressive, definitely. But wait, the GAAP loss was $90 million and the adjusted net loss was $61 million. That's a $29 million difference. The $38 million in cost cuts doesn't fully explain that gap, so the remaining difference must be coming from those financial adjustments, the add-backs you mentioned.
Exactly. And the single biggest add-back, the most significant non-GAAP adjustment in this quarter for Opendoor was stock-based compensation, SBC. It totaled $31 million for the quarter. Yeah. Now remember, SBC is a non-cash expense. They're paying employees with company stock, not with dollars from the bank account. GAAP rules require them to book the estimated value of that stock as an expense on the income statement, which naturally increases the reported GAAP loss.
Right, but then when they calculate their preferred adjusted net loss metric, they take that $31 million non-cash charge and they just add it back. They basically erase it from the loss calculation.
That's precisely the mechanism. They add back the $31 million SBC expense, along with a few other smaller non-cash items, to get from the GAAP 90 no remitter net loss to the much smaller adjusted 61 remitter loss. So in effect, they are sacrificing future shareholder value now through dilution, which we saw increasing the share count back in slide 1 in order to make their current operational results look cleaner and better today.
Okay, that makes sense now. It's a combination. The improvement in those headline adjusted metrics isn't just smoke and mirrors, but it's not purely operational either. It's a powerful blend, like you said. Roughly $38 million in genuine, cold, hard cash savings from cutting overhead, combined with about $31 million in non-cash accounting adjustments, primarily from stock compensation.
Understanding that distinction is absolutely key. It prevents you from being misled by just looking at the adjusted numbers that management wants you to focus on. You have to see both sides, the real cuts and the accounting maneuvers.
Okay, so the unit economics are clearly under immense pressure, but management is aggressively cutting fixed costs to compensate. This whole situation really underscores how critical their financial structure is. Which brings us neatly to the balance sheet. All right, slide 3. Now, for a company like Opendoor, which is fundamentally in the business of buying and selling these incredibly expensive assets, houses worth hundreds of thousands of dollars, the balance sheet isn't just important, it's practically everything. They're a profoundly capital-intensive business. They rely heavily on debt, on leverage to finance their inventory of homes. So let's start by looking at their liquidity situation and how they're managing inventory risk.
Yeah, the balance sheet is absolutely paramount here. And the most striking figure, the most dramatic change you see on the balance sheet this quarter is that massive drop in real estate inventory. It fell by an incredible 51% just since the end of last year. 51%. It went from nearly $2.2 billion, $2,159 million, down to about $1.05 billion, $1,053 million.
Wow, they liquidated over half their physical assets, their houses, in less than a year. That's a huge strategic shift. We touched on why they did this earlier, but let's just reiterate the specific strategic goal behind this massive inventory reduction.
This wasn't an accident. It was a very deliberate, calculated, strategic, de-risking maneuver by the new management team. What they did was intentionally slam the brakes on their home purchasing engine. If you look at the transaction numbers for Q3, they all sold 2,568 homes, but they only purchased 11,169 new homes. Less than half the number sold. They did this on purpose to aggressively flesh out all that old, low-margin, potentially toxic inventory that was dragging down the contribution margin we just discussed in slide 2.
So essentially, they accepted the pain we saw in slide 2, the big revenue beat, because they were moving old inventory quickly, and the simultaneous margin collapse, because they were taking losses or low profits on that old inventory. They accepted that pain as a necessary evil to achieve a specific balance sheet outcome.
Exactly. And what was that outcome? Safety, financial flexibility. The strategy, while painful on the P&L, was successful in converting that risky, low-margin inventory back into cold, hard cash. As a result, their cash and cash equivalents position actually rose substantially. They ended the quarter with $962 million in cash. That's a pretty significant war chest they've built up. And that's critical because it signals they now have the breathing room, the flexibility to actually execute the new strategic pivot they're talking about. They have the capital ready to start buying homes again, presumably using their new smarter AI-driven models when they feel the market conditions and their technology are right.
Okay, building up cash sounds like a strong move, a necessary step for a turnaround. But we can't just ignore the other side of the balance sheet. The structural weakness, maybe the Achilles heel of the whole iBuying model, has always been the reliance on debt, on leverage. What does Opendoor's debt load look like right now, and how does that financial burden potentially constrain this new Opendoor 2.0 strategy?
Yeah, leverage is the ever-present shadow hanging over this business model, and Opendoor remains very highly leveraged. If you look at their balance sheet, they report $1,889 million, let's call it $1.9 billion in total liabilities. Now, that includes their actual debt facilities used to buy homes, but also things like accounts payable and other financial obligations. And that $1.9 billion in liabilities is sitting against only $811 million in total shareholders' equity. That's the book value of the company's own capital.
Okay, $1.9 billion in liabilities versus $811 million in equity. If we calculate the debt-to-equity ratio, which is a standard measure of solvency and financial risk, what does that number come out to?
It gives us a very high debt-to-equity ratio of 2.33. Now, to put that in really simple terms for the listener, for every single dollar of shareholder capital representing the company's own skin in the game, so to speak, they are using $2.33 in borrowed money or other external liabilities to finance their operations and inventory. That's significant leverage.
2.33. Yeah, that is high. And that's the ultimate double-edged sword, isn't it? Especially in a market as cyclical and sensitive as real estate. High leverage can amplify your profits spectacularly when home prices are rising and margins are good. But it absolutely turbocharges your risk and magnifies your losses when things go the other way, when margins compress like they just did in Q3.
Precisely. And that high leverage on the balance sheet translates directly back to the income statement as a painful, recurring fixed cost. We already mentioned it briefly, but it bears repeating. That non-negotiable interest expense of $36 million per quarter. $36 million just servicing their debt. This is the underlying structural reality that the fancy new AI strategy must find a way to overcome. This cost has to be paid in cash every 3 months, regardless of how many homes they sell or what the contribution margin is on those sales.
So if the new technology doesn't work as planned, or if the broader housing market takes another downturn, even for just 1 or 2 quarters, that $36 million interest payment becomes a massive drain, rapidly depleting the $962 million cash reserve they just built up.
That's the pressure. It dictates everything. It dictates why the new management is so relentlessly, almost obsessively, focused on buzzwords like resale velocity and operational efficiency, because that debt clock is always ticking, $36 million every quarter.
They absolutely need speed then. The faster they can buy, maybe lightly renovate and resell a house, the less interest expense accrues against that specific property's capital.
Indeed. The fundamental, inescapable necessity of servicing that $36 million quarterly interest bill means they simply cannot afford to have slow inventory turnover. It's poison to their model. They must generate enough contribution margin quickly enough to cover not only that interest cost, but also all their operating costs, even the reduced 134M. If they can't achieve that velocity and margin combination consistently, they will just continue to bleed cash, heading towards zero. It's that stark.
Okay, one last quick point on this slide before we move on. Shareholder rewards. Given this intense need for capital to fund operations, cover interest, and invest in the new strategy, I'm assuming there are no dividends being paid out or any share buybacks happening.
Zero. Not a penny. The cash flow statement confirms it clearly. Opendoor is very much a heavy consumer of capital right now, not a distributor. They spent absolutely no money on dividends or share repurchases during the first 9 months of 2025. And that's entirely consistent with a company that's losing money, restructuring its operations, and needs every single cent it can get its hands on to cover those operational losses and finance this ambitious new strategic pivot they're planning.
Right, makes sense. So the balance sheet reality is defined by high debt and an urgent need for speed and efficiency. That actually sets the stage perfectly for what management unveiled next, their new strategic narrative and outlook for the future. All right, slide 4. This earnings report felt less like a backward look at Q3 and much more like a forward-looking launch event for Q4 and really for 2026. The new CEO, Allocation, he really used this moment, this platform, to aggressively pivot the company's entire identity. He literally called it a refounding of Opendoor. Let's talk about this Opendoor 2.0 narrative.
Yeah, the narrative shift is incredibly stark. It's a complete rebranding effort almost. The absolute core quote, the one that defines this new direction, is Najation saying, "We are refounding Opendoor as a software and Al company," end quote. He's making a very conscious effort to completely reframe how investors perceive the company. He wants them to stop thinking of Opendoor as just a highly leveraged real estate brokerage, basically a flipper using debt, and start viewing it as a sophisticated, data-driven technology platform that just happens to operate in the real estate market.
And he was pretty blunt, wasn't he, about rejecting the old strategy? He seemed to suggest the previous approach relied too much on just riding favorable market waves. I think he said something like future success will come from building proprietary technology, specifically, and this was the line that jumped out, not from charging high spreads and hoping the macro saves us. Why? That feels like a really powerful, direct repudiation of the way things were done before he took over.
Oh, absolutely. It's a strategically brilliant move, actually, particularly in terms of managing expectations. He's effectively taking ownership of, or at least acknowledging, the failures of the old model, the failures that led directly to that disastrous 2.2% contribution margin we saw. And he's immediately shifting the entire focus onto this new future-oriented technology solution. It's classic new CEO playbook stuff. He's laid out very clearly that he wants Opendoor and his leadership to be judged going forward on three specific forward-looking objectives. Let's list them out. 1, scale acquisitions but doing it smartly using new AI-driven pricing models. 2, improve unit economics and resale velocity, hitting that crucial speed and margin metric we keep talking about. And 3, build operating leverage, meaning as they grow transactions again, the revenue growth has to rapidly outpace the growth in fixed costs.
Okay, AI and software company. Scaling acquisitions with AI, improving velocity. But what does that actually mean in the practical sense of buying and selling houses? How is this Opendoor 2.0 supposed to use technology to fix that fundamental 2.2% contribution margin problem we identified? What's the mechanism?
Right, it's not just buzzwords. The promise comes down to prediction and precision, driven by AI. The new systems they're building, or claiming to build, need to solve three massive operational headaches that clearly plagued Opendoor 1.0. First, they need dynamic pricing. The AI has to be able to generate instantaneous, hyper-accurate offer prices for homes. The goal is to avoid overpaying by even 0.5%, because those small overpayments accumulate and directly lead to the kind of inventory write-downs and low margins they just experienced. Second, they need automated repair cost prediction. This is huge. Instead of relying solely on human inspectors who might miss things or estimate inconsistently, the AI needs to accurately and instantly predict the likely cost of renovations needed to get a house market ready. Avoiding surprises here is key to protecting margins.
Okay, smarter pricing, better repair estimates. What's the third piece?
The third piece is underwriting speed and selection. The AI needs to get much better at identifying not just accurately priced homes, but specifically the homes that are likely to have the highest velocity, the ones that will sell the fastest in the current local market conditions. So remember that ticking debt clock. Minimizing holding time minimizes that corrosive $36 million quarterly interest expense burden per home. So the promise of Opendoor 2.0 is this. If the AI can deliver on superior accuracy in pricing and repairs and guarantee faster selection and resale velocity, then they believe they can consistently push that contribution margin back up, maybe above 4% or even higher, and finally achieve sustainable, positive operating leverage. That's the core technological bet they're making.
Okay, that's the long-term vision, the promise of AI. Now let's pivot back to the immediate future, the actual financial guidance management gave for Q4 2025. Reading through it, it sounds intentionally awful, like shockingly bad.
It is intentionally awful. This is what analysts often call the kitchen sink quarter. And it's a very common, very crucial strategy for a new CEO taking over a troubled company. Management basically guided for a complete catastrophe in Q4. They threw everything, including the kitchen sink, into the guidance to clear the decks completely. Just look at the numbers they put out there. They expect revenue to decrease yet again by another 35% quarter over quarter from Q3's already lower base. They explicitly said the contribution margin will be below Q3 2025, meaning it's going to sink even lower than that already terrible 2.2% level. And maybe most tellingly, they expect the adjusted EBITDA loss to widen significantly again, ballooning up into the high $40 million to mid $50 million range, way up from Q3's $33 million adjusted loss.
Yeah, guidance like that is absolutely guaranteed to send a stock tumbling, which is exactly what happened after the call. But you're saying this wasn't just predicting disaster, it was almost engineering the expectation of disaster. This is self-inflicted strategic pain.
Absolutely, 100% strategic. Think about why the numbers are guided so low. Revenue is crashing because they intentionally slowed down acquisitions back in Q3 to preserve cash and clear out the bad inventory. Fewer purchases in Q3 means fewer homes available to sell in Q4. The margins are guided to sink even further because they are using Q4 to clear out the absolute last dregs of that old, low-profit, structurally damaging inventory acquired under the previous regime. Get it all off the books now. So by forecasting this maximally terrible Q4, they're doing something very specific. They are setting an incredibly, almost impossibly low baseline for performance.
Ah, I see. Which means that any results they deliver in Q1 of 2026, which should theoretically be based on homes acquired using their new AI systems and strategy, any improvement off that disastrous Q4 baseline will look like a massive, potentially heroic turnaround, assuming, of course, that the new strategy actually works.
Exactly. It allows the new CEO to effectively hit the reset button. He can blame the terrible Q4 on the cleanup from the old strategy. Then, starting in Q1 2026, he can show, hopefully, spectacular sequential improvement quarter after quarter as the new AI-driven model kicks in. It allows him to build momentum towards that new, ambitious, long-term goal they announced, achieving adjusted net income break-even by the end of 2026. It's a textbook turnaround maneuver. Take all the pain up front, set a low bar, and then aim to consistently beat those low expectations as you execute the new plan.
Okay, that makes a lot of sense strategically, even if it's painful for shareholders in the short term. Before we move into our final assessment on slide 5, let's just quickly recap the 4 critical takeaways from these first 4 slides, just to lock them in for the listener.
Good idea. Let's summarize. First, the quarter was defined by that core contradiction, a revenue beat paired with a massive EPS miss. This signals severe margin compression, driven primarily by the necessary, painful flush of old, low-margin inventory. Second, this earnings report solidified a radical strategic pivot towards becoming an AI and software company. Management is betting the farm on technology to conquer the inherent risks and low margins of the traditional iBuying model. Third, we uncover the profitability paradox. Those headline-adjusted losses actually improved slightly, but this was a hybrid effect, partly due to a significant $38 million chunk of real cash cost-cutting and overhead, but also significantly boosted by $31 million in non-cash stock compensation add-backs in the adjusted calculation. And fourth, the shockingly weak Q4 guidance signals short-term pain for a long-term plan. Management is strategically setting the lowest possible baseline the kitchen sink quarter to position the new CEO for a potential turnaround narrative starting in 2026.
Perfect summary. Revenue beat EPS miss, AI pivot, profitability paradox, and the kitchen sink Q4. Got it. All right, let's bring it all together now. Okay, slide 5. We've reached the synthesis point of our deep dive. We've gone through the numbers, the strategy, the balance sheet, the outlook. If you, the listener, could take just one key insight, one central theme away from this entire analysis of Opendoor's Q3 report, what should it be?
I think the absolute central conflict that defined this Q3 2025 report was the profound battle, the tension between the cold, hard financial numbers and the management's urgent, aggressive, forward-looking strategic narrative. Think about it. The market completely ignored the positive number, the revenue beat. Instead, it fixated entirely on the negative numbers, the EPS miss, the margin collapse, and on the news story, the refounding, the AI pivot, and the brutal Q4 guidance that sets up that story. Management has essentially given us the blueprint, the promise of Opendoor 2.0, but the market's immediate reaction, that sharp 6.71% stock drop, is basically the market saying, we hear the story, but we are deeply skeptical. Show us the proof. They're waiting for execution.
And that investor skepticism, it's really rooted in those fundamental structural challenges we identified back on slide 3, the balance sheet realities, isn't it?
Absolutely. The skepticism isn't just about whether the AI is cool, it's about whether even the smartest AI can overcome the brutal financial physics of this business model. Investors are waiting for concrete, demonstrable proof that this new AI-driven high-velocity pivot can actually conquer those deeply ingrained structural challenges.
Yeah.
Specifically, the high leverage and the crushing weight of that high fixed interest expense, that high debt-to-equity ratio we calculated, 2.33, coupled with that relentless fixed $36 million quarterly interest expense that creates this incredibly demanding financial treadmill that Opendoor is constantly running on.
Which means ultimately the success or failure of this entire Opendoor 2.0 refounding hinges almost entirely on one single operational metric above all others: velocity, speed. Can they actually buy, prep, and flip these homes significantly faster and more efficiently than the interest costs pile up?
That's the entire ballgame right there. The technology overhaul, the AI, it has to be so demonstrably superior that it fundamentally changes the speed and the certainty of residential real estate transactions at scale. It's not just about eventually selling a house. It's about selling it, say, on day 45 instead of day 60 or day 75 under the old model. That seemingly small difference, maybe 15 or 30 days saved per house, when multiplied across thousands of transactions per quarter, that is potentially the margin of victory. That's how they might overcome that fixed debt cost burden. Speed is survival.
Okay. Which brings us perfectly to our final provocative thought for you, the listener, to maybe ponder as you watch this open door story unfold over the coming year or two. The big question to keep in the back of your mind is this: can a sophisticated software and AI technology overlay, no matter how advanced, truly conquer the underlying, fundamental, often messy realities of a highly capital-intensive, deeply cyclical, and heavily leveraged business like flipping real estate? Or will the sheer weight of the balance sheet, the debt, the interest costs, and the inherent unpredictability of the housing market eventually overwhelm even the smartest technological promises?
That's the multi-billion-dollar question, isn't it? And the answer will start to reveal itself very soon. My advice: keep a very close eye on that contribution margin percentage and the reported resale velocity, or days held in inventory, starting in Q1 2026. Those two metrics, reported in the next few earnings calls, will be the crucial proving grounds. They will tell you much more clearly than any narrative whether Opendoor 2.0 is actually working or not.
Excellent point. Track the margin, track the speed. That's the actionable takeaway for everyone listening. You should now be armed with the framework and the key metrics needed to track their progress and critically judge their performance against the new strategy and the new low baseline they've just established.
And just the standard reminders. This deep dive discussion is provided for informational and educational purposes only. It is definitely not financial advice.
Please always do your own thorough research and consult with a qualified financial professional before making any investment decisions based on anything you hear here.
Also, it's important to note that this analysis was generated by leveraging an artificial intelligence model, which integrated official company financial data with publicly available market information and consensus estimates.
And as always, we encourage independent verification of all the data points and figures discussed.
Okay, I think that covers it for Opendoor's Key 3.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.